Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 18th of July. It's been another turbulent week. There's been a lot of things for investors to consider. US inflation, for example, came in at 9.1% against an expectation of 8.8%, and the very hot reading initially made investors wonder whether in fact the Federal Reserve rate hike in July would be 1% rather than 75 basis points. The Fed has subsequently quashed that to some extent. It's made the point that the inflation reading is after all historic. It's a lagging indicator. So 75% rate hike in July seems still to be the favoured outcome. On top of that, we've had a mixed opening to the US reporting season. A couple of the banks have disappointed in early days, although it still remains an extremely early part of the season. On top of that, of course, we've had the strength of the US dollar, which will work against multinational companies in the States, while the Chinese economy sharply contracted in the second quarter, perhaps not surprisingly, with the additional lockdowns it's had to enforce as a result of its zero tolerance policy on COVID-19. So in the year to date, the markets are currently looking as follows. The Dow Jones is down by 16%, S&P 500 20%, Nasdaq 28%, and our own FTSE 100 is currently down 4%. Looking to next week, there's a couple of companies reporting, both of whom for different reasons have had a fairly rough time of it of late. First one is first quarter update from Royal Mail. The shares are down 51% over the last year, which has resulted in their recent demotion from the FTSE 100 into the FTSE 250. There's a couple of historic things which have been working against it. Obviously, the death of letters. On the plus side, we have seen an increase in parcel volumes, largely driven by internet spending, but of course with an impending cost of living crisis, that has tended to weigh on the shares. On top of that, there's the possibility of industrial action, which could put something of a spanner in the works in terms of Royal Mail's transformation programme, and general inflationary cost pressures aren't helping. Dividend yield of 7.6% is something of a sweetener. There's also been a special dividend and a share buyback on top of that, but ultimately the share price has not been performing. Similarly with Ocado, where half-year numbers are due, shares down 58% over the last year. If you think of breaking this business into two parts, the first one is its joint venture with Marks and Spencer. Now similarly, although Marks and Spencer's food offering has for a long time been its jewel in the crown, again, cost of living could have an impact as consumers tighten their wallets. Nonetheless, it is the major provider of revenue in terms of Ocado at the moment. The other growth part of its business is the solutions business. This is its robotic systems, which it charges third-party retailers to use. It still remains ahead of its field in technology terms, but it's yet to turn a profit. And Ocado has tended to become something of a jam tomorrow stock. So it'll be interesting to see what progress they have been able to make. They had a £580 million fundraising in June, which was fairly well received. But obviously as a growth stock, they have taken something of a hit, as we've seen in the States with the rotation out of growth stocks into value stocks. Thank you for watching. Have a great week.